Hi, my name is Tim Mullen, and I'm going to present on an analysis I did of the stock market, which I think is quite timely given all the volatility that we've been experiencing over the past few weeks due to the coronavirus. So, some objectives are: can we predict the prices of stocks? I know this is an ambitious undertaking and question, but I figured I would give it a try because I was super curious about it. So, some questions. What are the key drivers of stock prices? And to what extent do news events and quarterly earnings reports drive the changes in stock prices? Sources. So I pulled the past 5 years of daily stock market closing prices for Google, Amazon, Apple, General Electric, Tesla, Lyft, Uber, and Microsoft. I captured the daily closing values for the S&P 500 index, also the daily opening values for the volatility index, the VIX, also known as the fear gauge. Major news events that impacted the value of the S&P 500. So I looked at lots of articles and attributed those to the stock market. Quarterly earnings surprise. So this is the percent difference of actual earnings from consensus estimates. So analysts will say we think that a company should produce 25 cents of earnings per share, and if they come out with 50 cents, then that would be a big surprise. So that would be a 50% or 100% earnings surprise. So executive summary. Um, I learned that more stock assets are managed passively by index funds than actively managed by stock trading firms. So that just happened recently, last August. And so 4.7 trillion are managed by index funds and 4.2 trillion by stock trading firms. 80% of the US stock market trading is driven by algorithms, computer models that are designed to automatically execute trades based off of um, the latest trends or information in the market. And 50% of those trades, or of all trades, are high frequency trading. So these are computers that execute trades within like 200 milliseconds. Some key inputs to these algorithms are the fear index, and I'll go into a little bit more in a second of what that is. Um, News cycles, whatever's going on in the news, politics, economics, health, social, etc. Quarterly earnings surprises, which I discussed a moment ago. All of these are key inputs to the models that can trigger massive swings in the market. The stocks in this analysis have highly similar price volatility patterns to the S&P 500 index. I'll show that later. And ultimately, short-term stock price projections are unrealistic. Long-term investing is a more worthwhile analysis and endeavor. So here's some key context. The S&P 500 is an index considered to best represent the U.S. stock market. The average annual total return of the index is 9.8%, and that's going back to 1926. And its posted annual increase is 70% of the time. And a key point here is its value is weighted by more valuable companies. And so often 75% of the returns or volatility is related to about what's happening with, or can be attributed to 50 to 75 of those 500 stocks in the index. Um, and the fear index, what it is a measure of a 30-day forward-looking volatility. And so it measures the future value traders place on stock options. And it averages 19.2. So you can see that in the graph on the right. Um, since 2019, it's been sitting a little below 20, um, but just recently it's been spiking due to the coronavirus, and it's gone all the way up to 80 or a little bit beyond that. Um, So uh, an option is basically an instrument where a trader gets the ability to buy a stock. They buy a contract basically, and they say, okay, I'll buy this contract, which will allow me to buy a stock at a certain price later on based off of what I think the market is going to do and where that stock is going to go. So they're essentially predicting the stock price. Um, if they predict a price that's very different from the current price, then there's a lot of they're predicting a lot of volatility in the market. And when a lot of traders are buying these options, they're essentially conducting a survey of how fearful they are of the market changes. So this index measures all of those options that people are buying and says, okay, how far is that spread? If it's a really wide spread, then it means that we have a lot of fear in the market. So I did a comparison of the fear index in the S&P 500, and I mapped major news events that cause the market to shift upwards or downwards. So going back all the way to 2015. So you can see on the top left, um, we have the event of the Chinese stock market crash. And at about that time, you saw the fear index spike up dramatically, right around the days where the stocks got sold the most. So there were two major stock market crashes in 2015 related to China. Um, and the first was around July, August, and then the second one was around January, February, and that's exactly when the stock market, uh, the S&P 500 experienced those dips as well. Um, Later in 2016, in the middle of 2016, we had a small dip, and that was related to Brexit, and you can see the corresponding fear index spike there. Then later, going into 2016, was the presidential election, and prior to the election, there was a lot of uncertainty of who's going to be president, and whoever's president has a big impact on the economy. So you saw some dip in the market there, fear index spiking, and then when Trump got elected, thereafter the stock market began this really long rally of increased value, which we've all experienced over the past few years. Um, Through 2017 and towards the end of 2016, there were some rate hikes that occurred, three of them in 2017. And you'll see some small little blips in the fear index and the S&P 500. Um, and then Trump pushed through some tax cuts, and that drove a major peak in overall S&P 500 value. But then we kind of fell off a cliff at the start of 2018, and it was really driven by a fear of inflation. And that fed right into the fear index, and it caused a large sell-off. People started seeing higher S&P 500 levels than they'd ever seen before, and it just caused a large concern of inflation. And then if the fears kind of abated a little bit later, the stock market rallied, and then it kind of bounced around for a little bit until we hit the trade war issues with China, and you'll see the trade war feeding lots of valleys over the next basically through 2019. Um, and the lowest valley happened um, towards the end of 2018 when there was lots of talks of uh, the Fed implemented a rate hike, there was a government shutdown, and there were trade war escalations with China at that period. Um, uh, and then there was a strong quarterly earning towards September of 2019, which made people feel stronger about the economy, and there was an uptick there, followed by some more trade war with China, and then there was a trade deal with China in Q4 2019, and that caused a huge rally until present day, where now we have the coronavirus and all the fear that is spiking up. You can see it's just skyrocketing for the fear index. So those are the drivers for the overall S&P 500 stock market. And I was curious, how much of the drivers of the S&P 500 plays out at the individual stock level? And so what I did was I did like I kind of made up my own little statistical model of a rolling 5-day normalized mean. Um, basically I'm taking a 5-day average, and then I'm looking at that average and taking the percent difference um, of that stock over the previous 5 days, and I'm doing that for the Amazon stock and also the S&P 500. I'm saying, okay, if the S&P is going up by a certain percentage or going down by a certain percentage or ratio, well, to what extent is Amazon also doing the same thing? And the results were actually very striking to me. Um, it's nearly a one-for-one correlation. You can see towards March of 2020, towards the right. I mean, the lines essentially blur together. They're doing the same thing. Um, and but it's also interesting that there are events that happen where they diverge significantly and they don't seem related at all. So you can see towards the end of 2019, Amazon reported the highest holiday shopping sales that they had ever had. And that caused the market to really want to buy more Amazon shares. And so the price peaked during that period. Um, and then at the beginning of January, when the U.S.-China trade deal was signed, the S&P 500 had a larger spike in pricing, but Amazon went down a little bit. And the reason for that is there was some specific language in that trade deal that addressed counterfeit issues that Amazon has a lot of issues with. And so that was perceived to be as increasing the scrutiny on Amazon, which would be more bearish for them. So they had a negative driver through that event. And then there was a really high earnings report that came out for which was reflective of the Q4 sales. Um, so that occurred in January 31st, and it was 63% higher than what was estimated. So really high peak report, and really good news for Amazon. So it caused the stock to increase significantly as compared to the S&P 500, which was down that day. So interesting how these drivers can interact with each other. I did the same analysis, a 5-day moving average converted to a ratio for Apple. And you can see again, there's a lot of similar activity when the market's up. It's kind of moving along with it. When it's down, it's moving along with it. But there's some key periods where there's differences. And key differences, first call out on the left is in December, an analyst, a financial analyst, I guess who's well known, he had a very positive projection for Apple stock, said it could go up 25%, and it just caused the market to really rally to buy that stock. Um, and then there was an earnings report in January for Q4, and it was 10% higher than what was estimated, and it caused the price to go up a little bit, even though the overall market was down that day. Same thing for GE versus the S&P 500. Um, but I just wanted to call out here that a positive uh, quarterly earnings report and a negative one doesn't necessarily mean that the market is going to respond the way you would expect. So looking on the far left, the first call out is there was a negative surprise for GE, but during their surprise report, their quarterly report, um, they told the business community that they're selling their biopharma business, and investors view that as a very positive thing to help increase the business value. So the stock really rallied that day. It was a huge buying day. Um, the next quarterly report that came out, GE had really strong earnings, but that came out during a period in the S&P 500 where people were really concerned about inflation fears. So overall, the market was down at that point, and you didn't see a corresponding reaction in the stock price. It was slightly higher, but not by much. Um, the next quarterly earnings report was really muted by the China trade war. The overall market was down at that point. GE stock was higher, or the not higher. Their quarterly performance was higher than expected, but it just really didn't get the attention because the overall market was down. And then finally, in the most recent quarterly earnings, um, they reported uh, there was a positive surprise again, and there was broader market sentiment that the China trade deal was going to work out. And so, based off of their consistent overperformance, the market responded, and they reacted to that news, and they started buying the shares in response to that. Um, I also wanted to just look at a more broader perspective of GE stock, and um, I, in this case, what I did is I changed the normalization model to do a linear scaling. So basically, I set it on an index of between 0 and 1 over the past 5 years, both of them, so that they could be at the same level, and we can look at what their price has been doing from start to finish. And so you can see on the left-hand side for GE, their stock was highest from 2015 through October 2017, and then it hits this inflection point, um, which I had discussed on the previous slide, where um, GE. Oh, I'm sorry, this wasn't on the previous slide, but this was their major inflection point where the business started to drop. So GE announced, they poor quarterly earnings. The market was super surprised by this. It was around 45% lower than what they were expecting, and um, as a result, the market said, GE's got a lot of financial troubles. They slashed their dividend, and they're going to be selling $20 billion of their business assets of different business units to try to shore up their business. So huge alarm bells for everybody, and the stock just begins to tank from there, and it hasn't recovered since. So you can see more recently, the overall value of the stock is essentially down in the zero point 0.2 range, whereas it had started in the higher zero point 0.8 range. And then you can see the S&P 500, it just has this long-term gradual increasing trend over the past 5 years. And it's at its highest level that it's been at, except for in the past couple weeks where coronavirus has come in and it's really wiped out a lot of the value that we've experienced um, that has been attributed to the Trump era. And just keeping in mind, a long-term perspective when we look at stocks, um, like you can see, I call out here the S&P 500. You can see the S&P 500 from 2015 to now, it has significantly increased by roughly 50 to 60%. But you can also see some individual stocks that are really outperforming the market. Amazon, most notably, um, in orange there, has outperformed the market by 400, 500%. Um, and so, although the stocks follow the S&P 500 daily nuances, it's important to keep the long-term perspective and see that the value and the linear upward trend of the stock is quite significant. And so it's important not to just think that, well, we could just invest in the S&P 500, which you could do, um, and you would see, meaningful returns over time. Like I mentioned earlier, the S&P 500 on average returns 9.8% over time, or you could experience really dramatic growth in individual stocks as well. It just depends on your level of risk tolerance. You can see GE on the bottom, um, where the stock really begins to underperform and um, go negative over the long term. So obviously, you want to find stocks that long term are going to increase in value, and avoid stocks like GE. And it's just hard to know when you're in the midst of these short term cycles. What's interesting is you see Tesla stock in green dramatically increasing through Q4 um, by hundreds of percent. And it's really hard to predict when stocks like that are going to happen. So it's important to keep a diversified portfolio of different stocks because you just really never know what's going to happen. And it's good to keep an eye on the business fundamentals if you understand that. Um, but if you're not too savvy in all of those things, you can also be diversified into mutual funds that invest in a broad array of stocks that can take advantage of the long-term trends. So what are some recommendations and next steps? Well, I wanted to put my thoughts in the context of some advice from Warren Buffett. So he says, don't buy or sell your stocks based on headlines. A key question: has the long-term outlook changed at all? And that's something to definitely keep in mind. With coronavirus, has the long-term outlook changed as you're thinking about what's going on with maybe some of your investments? Um, Buying and selling short term, in my opinion, after going back and analyzing article after article of what happened at key points along the way, you read the article and the article says stocks plunge when they fall 2% or 1% or whatever, and then you take a step back and you look over the past 5 years and you see, well, yeah, I may have plunged 1%, but I'm still up 400%. It's something to keep in mind. Um, so buying and selling the short term is fruitless. The best thing to do is just keep a long term perspective. Unless, and I don't know much about this, but if you have a high frequency trading algorithm and if it's making money for you, then who am I to say anything about that? But for humans to do that, I think it's too much. Uh, Predicting prices short term appears to be infeasible, but there may be opportunities for long term valuations based on business model, reading the quarterly and annual reports, overall macro trends and econometrics like GDP, what's going on with technology, artificial intelligence, social trends, or more people moving from like this was a major social trend of the 20th century. More people moved out from farm environments to the cities. That massive trend is still happening in China and other developing economies. And then Warren Buffett also says have cash on hand for buying opportunities. So what's going on in the market right now? It's unfortunate. We all lived through the 2008 experience as well, and looking back on that, I have to say I wish I would have bought more stocks at that time. I think that overall the economy is going to recover in the long term, and right now it's cheaper to buy stocks. It's a better time to buy stocks than it was 2 months ago. So something to keep in mind that if you have cash on hand, which implies diversification as well. Um, it's good to have a diversity of stocks that you own and also many kinds of assets, real estate, physical gold, cash on hand to be protected when situations change. And you can take advantage of opportunities like this. In 2008, I personally didn't have resources to buy stocks at that time, and so I didn't, and I missed out. And so right now, there's a lot of turmoil in the world and a lot of challenges. But um, when you keep the long-term perspective in mind, there's definitely opportunities to um, make some good out of the situation. So thank you, everybody, and best wishes as you complete this course as well.